Today we will talk about the investment advice of Charlie Munger, Warren Buffett's partner and number 2 of the Berkshire Hathaway investment fund. High priest of investment with Warren Buffett, he gives us indispensable keys in an interview for his former university, Caltech, in order to understand what will be made of the decade to come and what makes the difference between a saver and an investor. Come on, let's go. Charlie Munger warns that the coming decade will be tougher for investors than the decade that just ended.
Yes, because so many people are in it and the frenzy is so great and the systems of management, the reward systems are so foolish that I don't think it's going to work at all. I think the returns will go down, yes. In real terms, the returns will be lower.
Are returns going to be lower in the next 10 years compared to the past 10 years? The answer is yes in real terms because there is a mania in the markets. There are 2 interesting messages in this point of view. The first is that the equity markets have been seen as a way to get rich easily by the general public. Money printing policies are obviously a big part of this, as they have fueled the rise in financial markets. The problem with money printing is that it works like a drug. At the beginning it is very pleasant, but we know that printed money gradually degrades the quality of an economic fabric. So in order for the short-term effects of euphoria to compensate for the deterioration of the fundamentals, we need more and more of it over time.
And we're in very uncharted waters. Nobody has gotten by with the kind of money printing we're doing now for a very extended period without some trouble. And I think we're very near the edge of playing with fire.
The consequences of money printing are one of the most important questions because it is an extremely dangerous practice. In the end, we don't know how it will end because the rise in prices linked to monetary injections is always relative to the method of injection and the quantities involved. However, historically, we know that inflation is a monetary phenomenon and that it ends badly when we push this logic to its extremes. As the saying goes, any paper money, in other words, managed by the government, ends up returning to its intrinsic value, i.e., zero. Munger's second big idea about the decline in market performance in the 2020s is the notion of real performance. The word real means that we remove inflation from the posted performance in order to compare a performance outside of any monetary phenomenon. And there is a key point here. We know that the dynamics of inflation are a determining factor of market performance. Charles Gove expressed this in the form of a matrix in 1978, the economic quadrants. This idea was the basis of the work of the famous Ray Dalio, founder of the Bridgewater Investment Fund, on his all-weather portfolio. Here are the Gove economic quadrants. All-weather Ray Dalio. Each quadrant represents a specific microeconomic context based on the intersection of inflation and growth levels. In an article on inflation, Didier Darcet for Gove Intelligent Software shows the impact of each of these quadrants on the performance of financial markets. On this chart, you can see that in a period of growth, the performance is not at all the same if inflation is in an upward or a downward dynamic. Even in periods of growth, if inflation is rising, then the market is doing nothing. Over the long term, equity markets outperform by a wide margin in times of disinflation. That's just colossal. I think that's what Charlie Munger is talking about, because we're ending a disinflationary period that started in the early 1980s. We are living in a historical moment, a deadly one for the stock market, where we could go from a period of a disinflationary cycle to an inflationary one. In this hypothesis where inflation would structurally go up, the markets would be condemned to register losses, or at best, stagnate. Philosophically, we can understand that inflationary cycles are unfavorable to stocks if we understand inflationism as a cycle that devours future income. But fundamentally, the value of a stock is only ever the expectation of future income in the form of dividends. Beyond this long-term microeconomic context, Charlie Munger is the living proof that one can prosper as an investor in a deflationary or inflationary cycle, since Munger and Buffett have gone through both cycles with record profits compared to the markets. But then, What is Munger's secret to investing in the best companies that can weather crises?
But in the investment decisions, I think it's very helpful to be able to yourself be pretty comfortable with the big ideas and all the disciplines. And I think that it also, life's more fun if you do that.
In investing, what is important is to understand the big ideas of each discipline. Buffett tells us to only buy what you understand well, and Munger explains that he values understanding the big ideas in each field more than expertise. This is advice that particularly speaks to me because Buffett's vision helped me make my first millions, and Munger's advice makes me happy professionally every day. In other words, you need to understand the global issues of your time without being specialized in anything, in order to be able to detect the few opportunities that are within your reach and that make sense in the present timeline. From there, you focus on these opportunities, concentrate your efforts on them, and make a fortune if everything goes well. If not, you have a good chance of losing everything. I think that's the meaning of Warren Buffett's quote, "Diversification is protection against ignorance." It makes little sense if you know what you're doing. Personally, thanks to my YouTube channel, I have the great opportunity to study a large number of subjects thanks to the experts I meet and interview. From there, I had the opportunity to invest in a company in the energy field, as I know the managers of this company very well, and as it is at the crossroads of a constraint on oil and the organization of energy flows, I decided to invest a completely unreasonable part of my assets in this company alone. A few years later, after having invested hundreds of thousands, my assets turned into several millions. This is also what Munger said.
I did not make my fortune, such as it is, by predicting macroeconomic changes better than other people. What Buffett and I did was we bought things that were promising, and then sometimes we had a tailwind from the economy and sometimes we had a headwind. And either way, we just kept swimming. That's our system.
I didn't make my money trying to anticipate the macroeconomy, but by investing and holding on to that investment. Sometimes you had the wind at your back, and sometimes you had the wind in front. If you want to get rich, and I don't think that's appropriate for everyone, then once you find the right opportunity, you invest and you hang on to it against all odds. That speaks to me. Does this mean that everyone has to do the same thing? I clearly think not. Already becoming rich is not an end in itself, and all the time spent earning money can be spent in many other ways, depending on one's aspirations. Then the risk is enormous. You have to be a bit crazy to be ready to lose most of your savings on one or two strong convictions. When I explain to my wife that you can lose almost everything from one day to the next, it's in these moments that she shows me her love by not sending me to sleep in the next room. So this attitude is completely unreasonable when you want to manage your savings. In reality, the savers with common sense will try to make their 7% return per year to double their capital every 10 years without risking losing everything. This is much more intelligent. And this is where I find Buffett's quote about diversification dangerous for Mr. and Mrs. Everyone. When you manage your savings, you want to protect your capital with a return that ensures your success over a long term. Think about it. In 40 years, a lifetime of work, if you doubled your capital every 10 years, you multiplied your capital by 16. That's a lot of money, and you will have taken much less risk. In this case, diversification is an essential part of good management to balance volatility and risk in your portfolio, because you can't be an expert in everything. Finally, I'd like to end this video with one tip and one recommendation from Charlie Munger. Avoid being stupid by recognizing the limit of your skills. This is difficult because our brains make us think that we are smarter than others.
What I would say is the single most important thing, if you want to avoid a lot of stupid errors, is knowing where you're competent and where you aren't, knowing the edge of your own competency. And that's very hard to do because the human mind naturally tries to make you think you're way smarter than you are.
I am convinced that if you start from the premise that you don't understand much because the world is vast and complex, you will be much better prepared to invest than if you think you are smarter than the average person. I always keep in mind that one of the great human innovations that triggered the scientific revolution was doubt. Before the 16th century, all the cards were full. When we didn't know, we asked the priests who drew dragons and waterfalls on the maps beyond what we didn't discover. There was no doubt because the priest had all the answers. The real innovation was the arrival of doubt with unfinished maps, where we left blank spaces where we had not gone yet. So be proud to say, I don't know. On that note, see you soon for new videos. Ciao.
Thank you so much for watching. If you like my videos, please subscribe and don't forget to hit the bell if you want to be notified of the next episode. And if you want to invest in the stock market over the long term or diversify your financial portfolio, I'm offering you an analysis of the 8 European star stocks to have. Thanks again for watching and have a great day.